I took the opening range breakout strategy on NASDAQ and nearly 4x its returns over the past 6 years, using 3 basic optimization parameters. In this video, we'll be covering the baseline results, the 3 parameters that I used, and the next steps that we have to take to further validate the strategy and see if it's even worth your time. With that being said, let's cover the strategy logic, how it works, and the structure behind it. This document is prepared by Old Bainbridge Capital for informational and research purposes only. It does not constitute investment advice, solicitation, or an offer to buy or sell any financial instrument. Past performance is not indicative of future results. All backtest results are hypothetical and subject to the inherent limitations of simulated trading, including survivorship bias, look-ahead bias, overfitting to historical data, and the inability to account for real-world market conditions. The strategy described herein has not been audited by any third party. Results may differ materially from live trading due to slippage, commission, liquidity constraints, and market regime changes. Trading futures involves substantial risk of loss and is not appropriate for all investors. These results are made possible through the usage of Python and data from Databento. So here we have the NQ Opening Range Breakout strategy, otherwise known as the 15-minute orb. It picked up speed in 2024 and a lot of people started using it. I saw a lot of people promoting it, a lot of YouTube videos around it, and I'm here to see if it's actually worth your time. This will include raw results, filtered rules, and parameter optimization. No curve fitting excuses. And this is only part 1. In part 2, we're going to be going through walk forward analysis, Monte Carlo, permutation testing. All data and results have commission included throughout. I believe it is a 4.10 per side commission and a 8.20 round trip. That is exaggerative and not realistic. For example, I think in my NinjaTrader brokerage, it's around 4.10 round trip in total. So we're doing about double on the commission, but I think it's worth it. It's good to exaggerate the hard truths and really account for every little thing that might go wrong when you're testing the strategy in a discretionary or systematic style. So to start with, we have 1,548 baseline trades. We have 43,258 of a baseline P&L. And after our optimization and filtered trades, we come up to 1,238 with an optimized P&L, and again, almost 4 times the baseline result of 166,000. You can see the equity curve on the right, and we'll get a little bit more into how to actually define, how to criticize, and look at the equity curve in the proper manner. So as the title says, it is the opening range breakout. We're going to take the first 15 minutes of market open, 9:30 Eastern time. We're going to chart and mark out the high of the opening range and the low. Very important levels. We're going to monitor that 15-minute bar high and low, and in long positions, it's when price closes above the orb high, and in short positions, it's when price finally closes below the orb low. As you can see, we have an example here as if it were to be on a chart. This is exactly what it'd look like, assuming this is the 9:30 open, and this is the 9:44 candle. We're going to enter this trade on the first break only, and only trade once per day. If there's no signal, there's no trade. In the entry and management side, we're going to take advantage of the 1-minute interval. This allows us to enter as soon as possible and take advantage of that breakout immediately. Instead of using a 5-minute or 15-minute candle close, this gets us a little bit closer to that opening range breakout and taking advantage of it at its full opportunity. The entry can happen as early as 9:46. Given that, the baseline is going to be a 50-point take profit and a 50-point stop loss. I saw online there was a lot of 1-to-1 risk-reward ratios, and I thought it'd be best to replicate that as close as possible. Our exit is going to be, of course, either take profit, stop loss, or the end of the day at 4 p.m. Eastern time. Commission, as I said earlier, is 4.10 per side, 8.20 round trip, and we're going to be doing 1 contract on the NQ with no pyramiding involved. If you have a smaller account and these P&Ls and drawdowns are unattractive to you, you can always trade this on the micro NASDAQ. And if you're doing that, take every little bit of P&L and divide it by 10, and that will be what your micro profit would look like. So now let's look at our first equity curve. As you see, we have 43,000 of a P&L, a 52% win rate, 1.06 profit factor, almost a 40K drawdown, a Sharpe ratio of 4.5. The Sharpe ratio is a financial metric for risk-adjusted return on the investment. It is not only important for investing, it's also important in trading. It is a great way to actually measure the equity curve. The Sharpe ratio, as it goes up, the equity curve changes along with it. The lower the Sharpe ratio, you see jagged turns, you see higher highs, higher lows. You do not see a smooth from bottom left to top right equity curve that you want to see, and we'll get into that a little bit more. The expectancy is 27.9 per trade, not bad, but the biggest red flag that stands out when it comes to this equity curve and when it comes to the important data is the P&L and the drawdown almost matching. You do not want that. So the worst case scenario in the drawdown would be at any point in time over the past 6 years, this strategy lost almost 40,000 in profit, which is its total net P&L over 6 years. A big red flag from the equity curve as well is, again, not a smooth bottom left to top right curve. We're seeing valleys of equity and an overall jagged appearance. For the most part, even though it sounds a bit strange, you're going to want to look at equity curves as if it's a mountain that you're looking to climb. For example, in this first year, it's not horrible. We have kind of a staggered but a little bit of a consistent trend up, but we see a large drop off, peaks of up and down, and then even at the end, even though we gained a profit, once again, if you're approaching that mountain, it is hard to climb. We want something that's easy to walk on if you're looking at it from that point, a stable curve up, and not filled with these large peaks and drop-offs. Looking at the annual breakdown, it's very, very important. We're going to want to look at the year-by-year analysis to make sure that the strategy actually works through multiple market regimes. So with 2020, we have profit of 16K. 2021, a big red flag with down 14,000. 22 and 23 were close to break even, and the last 2 years were profitable, beating 2020 in both years. Now, it is a good thing to see that the past 2 years had the best performance. That shows that the strategy has a little bit of edge in recent times. However, you're going to want to see a consistent annual breakdown. You're going to want to see a consistent P&L throughout most years. It's okay if it jumps up and jumps down just a tad bit. This shows that the strategy falls apart based on current conditions in the economy and the market, etc. As you can see, we had a max drawdown of 23K in 2021. Our profit factor is in the red. It's underneath 1. And as a whole, the profit factor, I really look for 1.5 or above. That's how you know you have a strategy worth considering. We're not even close to that, with the highest being 1.17 in 2024. So overall, this is not a good start for the baseline. This is unfiltered. But now we're going to start asking questions. How can we better optimize this? And when it comes to optimization, it's important not to overly optimize every little thing, but we can start asking general questions. What days work? What time frames are the best? What stop loss and take profit are the best for my strategy? So let's look into it. Where is the edge and where is the drag? Looking at the daily performance, we see that Monday has a huge fall off, down 13,000 across 6 years. Our best performers are Tuesday and Friday, and Wednesday and Thursday are relatively break even. So my first thought is, obviously, let's test this and remove Monday. You might ask, why don't you just keep Tuesday and Friday, since over this past 6 years they were profitable, in comparison to the measly Wednesday and Thursday and the big drop off of Monday? It's important when you're optimizing not to just silence every little bit of noise, and you're still going to want a higher trade count, because the more trades you have, the more valid that your backtest actually is, in comparison to trading this on 100 trades versus 1,000, if that makes sense. For our first form of optimization, we're going to be keeping Tuesday through Friday and removing Monday solely because of its especially poor performance. So we've made 2 changes, only 2. We've taken off Mondays, as well as an entry cutoff at noon. It's common to see volume drop off after lunch in the afternoon period, and with a breakout strategy, it is commonly known that with not a lot of volume and not a lot of market movement, it weakens the edge, and it makes the trades not necessarily A+ setups. So we're going to be cutting it off at 12. It only shaved off a handful of trades, nothing extreme, and I think it's a worthwhile parameter to input. With these stats, we see an improvement of around 13.5 thousand in P&L, up to 56, a win rate increase to 52.5%. Profit factor went up just a little bit, but we're still under 1.5, so I don't like it that much. A max drawdown is now around half of our P&L. Instead of almost being equal, we improved by 11,000 on the drawdown. And as you can see, the increase of the Sharpe ratio also increases the look of the equity curve. And expectancy almost doubled to 45.9. So looking at the equity curve, it's obvious that it improved just slightly, but there are still a lot of red flags. Looking at it, we have that first initial peak, a big drop off. The valley is not as long, it is not as wide. However, we do still see a large increase in profit, which you would think is good, but again, we want a smooth and stable equity curve throughout the entire 6-year backtest. Another thing worth noting as well is, after this increased P&L, we had a huge drawdown immediately after and a flat line right here. Once again, we're going to want to see a stable curve from the bottom left to the top right. So let's look at the annual breakdown now that we've included the 2 parameters of no Mondays and a 12 cutoff. We're going to test this through the different market regimes from 2020 to 2025. This also includes a little bit of COVID. This includes the presidential election. It's important to have a backtest that is lengthy and incorporates a lot of different economic conditions. So we are now profitable in 5 of the 6 years. 2021 still stands out as a bad year. Even though the P&L and drawdown did increase, we are still under a profit factor of 1.0. Looking at the profit factors of the rest of the years, we are not close to 1.5 still, and we still have a good performance in the last 2 years. Overall, I'm still critical of this annual breakdown, and it is not worthwhile. So this is where it gets interesting. This is the next step. This is our third optimization tactic. We're going to take the stop loss and take profit, and we're going to test it on a range of different values. We're going to go from 25 to 100 points in 25-point increments. We have on our left the Sharpe ratio heat map, and we have on our right the total net P&L heat map. In these heat maps, it's essential that the green, or I suppose the high Sharpe ratio or high total net P&L, are not concentrated in one section. We're going to want to see an even spread of green throughout the entire map. This proves that the strategy still works at different risk-reward ratios. As you can see, our best combo was blatantly the 75-point stop loss and 100-point take profit. That is a positive risk-reward ratio. We have a Sharpe of 1.3, which has improved significantly. Profit factor of only 1.19, bordering 1.2, which is again well below 1.5. Our win rate actually went down, but it makes sense now because our take profit is around 25 points higher than our stop loss, meaning it is less likely to be hit. Max drawdown is still around 21,000, and overall, I do like what I see. Something really important to also note is if we see an outlier. For example, if the rest of the heat map was red and there were only 1 or 2 boxes that were green, 1 or 2 parameters or optimized data that actually work, that is a giant red flag. You're going to want to avoid that. You're going to want to see the spread. What that really means when you see that is a pure example of overfitting. So if every other combination except 75 and 100 did not work and only 75 and 100 worked, that is a true case of overfitting. It is the back test optimizing and adjusting its data around the only good result. When you see that, you're going to want to stray away from the strategy, consider other indicators or ideas to optimize, or just completely walk away from the strategy itself. So now we have the combined equity curves of the core baseline strategy and the optimized strategy. So as a refresher, the baseline is going to be a 50-point stop loss and take profit. Entries are going to be from 9:30 to 4 p.m. and we're trading on every single day of the week. The optimized one is once again a 75-100 combo with a 12 p.m. cutoff and not trading on Mondays. As you can see, we nearly 4x our P&L up to 166,000. Our win rate, like I had said, went down, profit factors up, drawdown increased from a baseline of almost 40,000. Sharpe ratio went up and our expectancy also went up. Not a surprise. Something worth noting is the drawdown didn't decrease significantly. However, with the P&L rising, it is a much smaller percentage of the profit that was generated over the last 6 years. So a max drawdown, it is scary, but if in comparison to the P&L, it is small, it is worth your time. Once again, I would like to note that if you were trading micros, you can divide the drawdown and the net P&L by 10, and you'll be able to see what that strategy would look like with less risk. So looking at the equity curve, very important. We do see now the Sharpe ratio increased, and we see a smoother trend, a stable trend from the bottom left to the top right. Things that still stick out though, we're seeing a lot of flatlining, we're seeing a lot of periods in time where it performs well and then doesn't do anything at all. We're not seeing big drop-offs, which is great, but it is still not as smooth as I'd like it to be. You have to be critical when it comes to analyzing this data. What is obvious to see is we saw good performance in edge from 2022 to roughly the beginning of 2023, a big flatline period all the way to the middle of 2024, and then a giant increase from then on until 2025 and another flatlining period. This is not the language we want to hear. This is not exactly what we want to see. While it is better, this shows that the strategy is conditioned on certain market regimes and performs better in specific environments. I also wanted to add, take these criticisms of the equity curve with a grain of salt. If you're a discretionary trader, it is actually possible to smoothen out that curve yourself using confluence between different indicators, strategies, or ideas. If you know how to read the market, whether it's sentiment or trend, you can see much better performance than taking it at every single signal like the backtest does. This brings to light why backtesting and stress testing is so important for both discretionary and systematic traders. Once again, we're going to look at the annual breakdown. It's very important. As you can see, the thing that sticks out the most is 2024 accounts for almost 40% of the total P&L across the 6 years. That is not a good thing to see. It's obviously worse to see that it performs poorly, as we saw on the first baseline, but it is not much better to see that it had a really great year because I wasn't trading that year. This is all historical. Who knows what it's going to perform like in the future, and we could see a spike like this on the other side. It is good seeing that the rest of the years are around the same in P&L. Obviously, it's not going to be perfect every single time, and every year is profitable, which is great, but 2024 is such an outlier, it is worth considering why. 2024 included the presidential election and a lot of other events. There was a lot of volume in that year, and that could suggest that breakout strategies work more in those environments, which would make sense. Our profit factors are still struggling, with the highest being 1.49 in 2024, but again, that is an outlier. We cannot expect that every single year. If we were to reduce 2024, we'd be looking at around 20 to 25,000 per year in profit when it comes to the NQ strategy. So overall, what the data actually says. 1. The raw strategy has a thin edge. With a baseline profit factor 1.06 on over 1,500 trades, it is real, but it's commission sensitive. When it comes to slippage or execution errors, that is not going to fare well. 2. Two rules meaningfully improve the quality. No Mondays and the noon cutoff. I'm not including the stop loss and take profit optimization there because there are different combinations, and that is truly up to the trader to decide on how much they want to risk per trade. Monday destroyed 13,000 in profit. That is a structural drag. It is not random noise. On Mondays, we're usually pricing in the weekend action and the events that took place, so it is common to see certain strategies performing better or worse depending on that. 3. Wider stops were consistently outperforming. As you saw on the heat map, the wider the stops got, the better performance we saw in both Sharpe, P&L, and other areas. 4. Every optimized year was profitable. There was a huge concentration risk in 2024 though, and stress testing will interrogate this. And 5, last but not least, this result needs stress testing. We're going to be doing Monte Carlo, walk forward out of sample analysis, permutation tests, and more. If you have no idea what I'm talking about, once again, that's going to be in the next video. I'll define what's actually happening, why it's relevant, and the data behind it. This will prove whether or not the strategy has genuine edge or it was 6 years of well-fitted historical data. If you have a personal strategy and whether or not you trade it discretionarily or systematic, I would love to backtest it for you and bring this important data to light. Manual backtesting is a real way of going about it. However, doing years and years of backtesting is unrealistic and not even possible on certain charts. Through Old Bainbridge Capital, I'm able to validate and stress test your strategy for you. If you're considering buying a course or you follow someone else's strategy, this is a perfect opportunity to test if it's worth your money and most importantly, your time. If you want to take the next step in trading, my freelance link is below. You can always shoot me an email as well if you have any questions. Backtesting is not only for systematic traders, it is even more important for discretionary. Having this data is essential for any profitable trader. With that being said, don't forget to like, subscribe, and comment what you'd like to see next, whether it's a strategy, idea, or another form of quantitative analysis.